Well, I'm still blown away by Susan's run, so I'm a little out of sorts because I don't know how she has the time to train and do all the stuff she does and then come in first in a world championship. Congratulations. So diverging views. This has been one of the most complex, confounding, and confusing economic and market environments in history. I think that's due to the fact that we have had two once-in-a-century events, the great financial crisis and then the pandemic, followed by a war in Europe for the first time in 70 years, all occurring at the same time. We're introducing some of the greatest technological advances in history. And we also are doing this during a period of some of the most intense geopolitical tensions, the worst demographics, rising debt burdens, major national security issues around food, energy, climate, and defense, increasing social stresses, and worsening inequality. So it's easy to see why there's diverging views and two sides of this, but we've also have been going through one of the most unusual periods in history from a monetary and fiscal perspective. We had the most highly accommodative monetary policy we've ever experienced, which turned into one of the most aggressive tightenings in history, probably the second most aggressive tightening versus 1979, which happened in a very short period of time and didn't give market participants enough time to adjust. And I think that's what we're struggling for right now. So this is an easy environment where you can make the case for both sides of the same argument. You know, inflation or deflation. You can make the argument for a hard landing or a soft landing, or how deep a recession we can have, whether the market's going to go up or down. There's a case to be made on each side of it. I want to cover three things. I want to talk about the landing, whether we can stick the landing or not, talk about interest rates and inflation, then talk about our views on the market. So we went from a couple of weeks ago to a no landing, from a hard landing camp for a hard landing and soft landing debate to the possibility of a no landing. I think we've moved past that now, and we're now into a hard landing or a soft landing. I think the difference between the two will come down to a very simple issue, whether we've contained the bank crisis. Is it going to be limited? And not that it's over by any stretch, although the pressures are easing, but we'll probably have other failures. But will we have a systemic crisis? Will determine, I think, whether we have a hard landing or a soft landing. I don't think we're in that camp right now. I think what the Fed did and what the FDIC did, as well as what central banks around the world did, first the Fed and the FDIC insuring deposits the way they did, or giving confidence about the insurance of deposits, and at the same time, central banks setting up the credit default swaps, I think ease some of the hard landing issues. But the question is the financial stresses from the bank crisis going to continue or not? You could argue that wages labor markets are all out of whack and wage pressures will continue to be high. You could also argue that the quantitative tightening, in addition to the rate increases, is too much for the system to handle, and that could push us into a hard landing. We know the yield curve is inverted, and M2 has changed in a way that really has upset the market. But I think it really comes down to, do we move into a full-blown credit crunch or not? On the soft landing camp side, they'll take the view that inflation is slowing. It's come down considerably. Corporations and consumers are still flush with cash. Consumer net worth, while it's come down, is still high. That there's been rolling recessions, so you're not going to take the one big hit all at once. There's no big one single recession coming. That we've had recessions in different areas. The latest is the banking industry again. But you've seen it in different parts of the economy, oil and gas segment at different points in time. Other areas right now, manufacturing is clearly hot. So we've had these rolling recessions going on. So that's another case for soft landing. That the recent stimulus has been so great that it's still impacting the system, even though we have tightening going on. And then lastly, as I mentioned, that the banking issues will be mitigated by the policy actions taken. I think the argument for a soft landing holds right now. unless we see a backsliding in the banking system in the US, I think we'll likely be in a position where we'll see a softer landing, but it won't be easy on segments of the economy. And I think that's one of the things that people confuse in these environments is soft landing or hard landing really depends on which neighborhood you're in and how impacted you are. We do have massive employment right now, but if you're part of the unemployed and struggling to find a job because your area of the economy is not in favor, then that's a hard landing. If you're in the camp where you're cruising along and you move from one tech company to another because it's easy to find jobs for engineers, that's a different story as well. So then shifting to rates and inflation, I think the issue on the soft landing or hard landing really is not narrowed to whether the banking crisis expands or not. I think what you're seeing is pockets of deflation coming through because the concerns and the 10-year dropped is one example of it. If I click forward and you look at mortgage rates and the housing being such a big part of the economy, when you see mortgage rates drop 80 basis points, still very elevated from where we were a year ago, but that is a big move to ease some of the pressures in the housing market and will likely bring people back into the market to buy. We still have the gap between buyers and sellers, but mortgage rates coming down, even the 80 basis points, is a relief on the system. I think that takes some of the pressure off. And what we may be finding is that the issues facing the global system today are doing the central banks work for them by bringing inflationary pressures down. And we'll continue to see that in the numbers. But we are going through this period where the central banks still believe they have more work to do. You're seeing this chart shows you the change in borrowing costs from the dark blue is minus 200 basis points, so cutting rates. The yellow is raising rates, and the dark yellow is 200 basis points of rate increases. So you can see a lot of increases still going on. So tightening persists and will likely continue, though I think we're getting closer to the end of the rate hike cycle. But we are in one of those periods where it can still go either way. But what's been a problem for the Fed and remains a problem is labor. We're at 3.5% unemployment. That's as low as we've had in basically 53 years. But we just saw a drop in the JOLTS number, the job openings number, by over 600,000, bring it below 10 million for the first time in almost 2 years. So that's a nice move. But equally impressive is the fact that job cuts are also accelerating. And as you can see in the red up here, that red line is 23. So we're looking over 100,000 announced job cuts, went down to 75 and back up to around 90,000 this last period. So there were previously unannounced cuts that were coming. You're starting to see the cuts coming. And as that happens, that eases some of the pressures on companies for wage increases, but even that market has big divergences. So you're seeing cuts in some of the white collar jobs and improvements in some of the blue collar jobs in wages. And that is a good thing for the system overall, but it does create some distortions and make it hard for the Fed to make their determinations. So you're seeing job growth moderating, employment rates declining still to record low levels. Those two are in conflict. So while the Fed wants to see a somewhat higher unemployment, when you're at 3.5%, it's hard to say that the system isn't still too tight, so that they're going to try and keep pressing the labor market a little bit more. They want to see a little bit higher unemployment, take some of the pressures off the system. But this is why I think it's still likely that you're going to see a 25 basis point hike this period. And keep in mind that the Fed has always said that they basically need about 4% of rate cuts to stimulate an economy and avoid a recession or bring yourselves out of a recession. So why are they so set on raising rates when it doesn't feel like they should? Is I think they're worried about having the wherewithal to cut rates to stimulate the economy when they need to, and that may be coming sooner than they'd like. They also have the lever of the balance sheet, which they've continued to tighten to the tune of $95 billion a month. that could be another lever that they bring down if conditions get too tight, too fast. But everything works in a lag, so that's part of the problem that we're going to experience. So as of Friday, the Fed was at about 4.875. They were projected to be at year end at 5.1, and the market was projecting there at 397. I suspect that the market will be coming back up to where the Fed is, but the Fed rates may come down, but it won't be because they're cutting rates. It may be because the market's pushing rates down themselves. But I think this is an area where the market's still out of sync, and there are expectations that the Fed will be forced to cut won't come true unless there is a full-blown economic crisis, usually spurred by problems in the banking system, which, as I said, I think are moving aside. So I think we're going to continue to see inflation moderate, that we're getting closer to the peak in interest rates, which means we're moving towards firmer footing for valuations, which is a good thing for the markets right now. But the markets are unusual too right now, and this is a chart that just came out in last night, and this shows you the S&P 500, and the rally we've had this year is highly concentrated. That the top 20 stocks account for 90% of the returns this year, and the top 5 stocks account for about 85 or 80% of the returns this year. So very narrow breadth year to date. If you look at the moving averages, the S&P is still not broken the 50 or the 200 in this trend. So we are still in an uptrend on that. And just recently, I heard yesterday, we'd love to dissect numbers for the market. Here's a statistic that the breadth in the market showed that 90% of the companies had positive breadth in recent period. And when we have that kind of a move, since it's happened 24 times previously, 23 of those times, 12 months later, the market has ended up significantly higher. This could be a market that surprises to the upside. And it's one of the reasons why I think people are who are waiting for the all clear sign are not going to get it. And you want to start moving in more aggressively with a discipline over the next 3 or 4 quarters. Bullish sentiment has changed. This is as of 4/6 last week. The weekly results from the AI survey showed bullishness up 10 points, bearishness down 10. They're both about 4% below or above their historical averages. So we're not too out of line with where we should be. And I think this reflects the diverging views, how even the bullish and bearishness is, even the neutral. These are very neutral numbers for the markets. So what happens next? I think it all depends on the banking system and credit, and how credit flows through the system and how the market reacts to that. So I think the Fed is likely going to hike at the next meeting, barring something blowing up in the banking system prior to that. I think they'll then likely say they're going to go to a pause. If they decided to pause at this point, I think that would be understandable, but probably a little premature. And I expect that there won't be a cut coming anytime soon. We continue to believe that the banking system is going through a transition that's going to cut credit to consumers, which is going to slow consumer spending. Although rates coming down on the longer end will help with the housing, which is a good shot in the arm for the economy. But we also think the corporate revenues are going to start slowing as the ability to pass on price increases starts to get hit. You're also seeing inventories build from some companies. So you could see some earnings start to get squeezed by rising costs. We still think you want to invest where the governments and corporations are telling you to invest, and the capital is going to continue to flow to a very narrow segment of the economy. So this is where we're putting our money today in industrials and materials. We like the defense and steel and rare earth plays. We think what's going on geopolitically, China's talking more about limiting supplies of rare earths and other key materials, and they're using national security as the rationale for it. So it's a stick in the eye back to the US from that. We still like the tech and communications area. They're critical to all the innovation that's going on. And with ChatGPT and AI really accelerating, the number of chips and data that's going to come out of that is going to be massive, and that's going to continue to give you opportunities there. We're proud owners of Pioneer Resources among the fossil fuel companies, so happy to hear that Exxon's looking to have some interest in that company. But I think the fossil fuel renewable transition is going to continue to take longer than we've anticipated. Most people have anticipated. I think global warming is real. It's rising and it's changing a lot of the problems. Water temperatures are up again, but this transition is going to be difficult. It's going to take a while, and you want to play both sides of it. I think healthcare is going to continue to be a big opportunity, and strong balance sheets are going to be a key part of it. But I'm pretty calm about what's going on. I feel much better about the banking system right now. I don't think the market's going to run away from us in either direction. I think it'll be range bound for the better part of this quarter, and then as we move into the second half, you'll start to see a lot more traction in the markets, barring any blowups in the banking system. So, Mark, I'll stop there, and we can open up for discussion. I'm sorry, I did have one more slide, so let me just share this because it's kind of an important part of the story. So when you're looking at opportunities, I would just say look where the market isn't really focusing on. And while I mentioned that Apple and others have rallied, can you see the market capitalization chart?
Is
that not coming up?
No, we can see it.
Okay.
Yeah.
So when we're looking at investing in the steel industry, which is absolutely essential for even just building all the fabs that we're creating and the manufacturing we're bringing back to the US, you wanted to invest and own the top 5 steel companies. As of October 28th, their market cap combined for the 5 most important US steel companies is $75 billion. The top 5 E&P companies is only $395 billion. The weightings in the S&P for each of these areas combined is less than, if you take that plus the top 5 defense companies, the combined weighting for those areas of the S&P would be less than 4%. And you could argue that where the government's told you they're going to be spending money and what we need to spend money on and invest in is clearly is going to be pushing into those areas. And with those kind of weightings, you should be probably double or triple those weightings in your portfolio, and you're not going to get that in the S&P. So this is where the opportunities are. We still like Apple and Microsoft. We think their cash balance sheets are going to be very healthy. And as we've just showed you, there's a big opportunity for those companies to continue to do well as they are already this year. But where there's money to be made is in the areas where others aren't investing and where the government is telling you to invest, and where you're getting, in many cases, pretty significant guaranteed returns, either because the government is giving you the contracts for a decade, or because the government in the defense companies is helping with their pension plans, or just the government's already told you that they're keeping competitors out, as they've talked about with steel and other areas. So I think this is an important element of thinking about investing in this type of environment. You really want to pick off the very specific areas where you can see opportunity beyond whether we're going to have more inflation or less inflation, or higher rates or lower rates. So I'll stop there, Mark.
Thanks, Stephen. Well, there we are. Questions, comments?
Stephen, the fossil fuel side is kind of bifurcated. You've got oil used in cars, oil being driven by OPEC to some degree, but then you have natural gas, which produces almost all our electricity and is somewhat local via pipelines or ships, and seems to be in a very different world than oil. So how are you looking at those two things in terms of E&P?
Yeah, we're playing it from the oil side because it is a global market. And whenever you're playing it, you're going to get the natural gas, but our focus is on the oil transition part of it, that it's going to take longer and that the underinvestment there has been greater, and therefore the return opportunity is going to be significantly better there in our view. not necessarily for the long term, but certainly in this environment.
Other questions, comments?
Stephen, we're getting into earnings season. And I guess the consensus is that, you know, everything's going to be down a little bit. But I wonder if the market has already kind of recalibrated for that, and that, you know, now it'll be sort of up and down kind of relative to, okay, everything is going to be down, but is going to be down more or less. Do you think that that's going to be, you know, a positive or neutral driver?
I think I think generally that would be a positive or neutral driver. I think this quarter there's going to be a little more specifics paid to debt and the balance sheets of companies and who their reliances are following the banking crisis that we've just had. What's their access to credit going to be is going to be a bigger element of that. What's their, you know, maturities and on their debt. Things like that are going to get a little more attention than they have. And therefore, I think the outlook for the second half of the year is going to be is more important in the calls. I think you're right. I think a lot of what's they're going to reporting is already reflected in the numbers. So I think the outlooks are going to matter. But I also think they're going to be wondering who's getting hit by the stresses in the credit area. And we're going to have haves and have-nots, those who can afford their businesses and those who can afford to keep their business afloat. And that's going to lead to a lot of M&A. So I think we're going to see a wave of M&A coming out of this as well, particularly in the banks. But I think it's going to be in other areas as well.
I've got my theories. Other questions, comments?
I should have taken both sides, Mark. I should have just taken one and then the people would argue. It's a tough environment, that's for sure. The IMF just came out and lowered
You know what
their
you could
growth
do?
expectations by a point,
Yeah.
1/10 of a point.
What you could do is you could just, you know, almost like as a late April Fool's joke, just take one side one time, then have the counter case in another presentation that you sort of pull off, and then that way you sort of get the reaction, and then you say, okay, let me show you the other part
We just
too.
need to have Rob on the call.
Yeah. All right,
Michael, I think you're up first.
Okay. Michael's up first. Yeah.
So, Stephen, you mentioned about the drop in mortgage rates driving activity. The problem is there's a lot of people, particularly in residential, that have 3.5% mortgages, and they don't want to give those up and buy something new. So there's just doesn't seem to be properties on the market.
Yeah, there is a big inventory issue, but there was also the hesitation that people were having that they missed it when rates moved up 1%, you know, the level they moved. I think the number I saw was versus a year ago on a $600,000 mortgage, you would have been paying $1,000 more of interest of cost a month. So when you do have an 80 basis point drop, it cuts into that. And that is the difference between affordability and not affordability on homes, particularly for the young people who are trying to get started. And ironically, I think a $600,000 house is moving closer to what starting homes is for people. So I think that, you know, that's a little bit high. I'm exaggerating, but the point is that is a big move on their monthly fees by having that 80 basis point drop. It doesn't change the dynamic of the people who won't sell because they have such a good mortgage. It's the people who are trying to get in. And there's a big subset of young people who are trying to get into homes and out of apartments.
So of course, Rob Colorina has Chat GPT and AI. He heard his name and then he pops on. But the other thing, though, there is another strategy to consider with tokenization. You can get some liquidity and keep those loans in place. Adam, you want to?
Yeah, Stephen, apart from the banking sector contagion possibility, what other factors, what other variables do you see that could change this from bullish to bearish? Because it is quite neutral. Yeah, everybody's got there's an argument for both sides. Strong arguments, I would
I
say.
worry that we've gotten too complacent about the war in Ukraine. The statistic I saw from, I think it was from Gallup or Pew, said American support for the war has dropped from 60% or 61% to, I think, 49 or 41%. And if we, and they have weapon issues, they have, Ukraine has military people issues. They've lost, I think, an estimated 120,000 soldiers. And I just worry that they might not be able to hold together in Europe for a spring offensive. So that would be something I think people aren't focused on right now, in spite of the fact that we've been at war for a little over a year now. I think we've gotten a little complacent there. I think the other thing is that that you just have the real estate area obviously is one. Commercial real estate is one of the big worries right now as well. So I think we'll be hearing more concerns about that and the impact of that on the system. But I think it's really going to come down to can the system adjust to the rate increases and the distortions that we have in the economy as fast as we've forced it on the system? And the answer is no. So then the question is, how much does it break when you have that kind of adjustment process? And so far, I think what the Fed and the central banks did has been remarkable to quell what was a real issue a week ago, to make it less of an issue now. Not that it's gone away, but it's less of an issue now. So I think that I would be worried about the war. I'd be somewhat worried about corporate earnings. I'd be worried about their debt levels. The other issue is, I was reading today that low-income countries are looking at debt costs of about 16% of GDP this year, going to 17% next year. That's an unsustainable number. So I think the strains there are going to be high. And then, you always have the China issue. I think one of the things that's worked in the favor of inflation, though, this year that isn't getting talked about as much is the China reopening has been much more muted, and their goal of getting quality growth and not stimulating the global economy, I think, has been a positive for inflation. And it's actually taken some of the pressures off the system that way too, which isn't getting much credit or even discussion. So I think that's a positive as well. So I think it's going to be mixed, Adam, but the war is one that I really worry about now.
Thank you, Stephen.
Anyone else?
You had Macron saying that they should be less U.S. oriented and more independent and all that, which is what he should be saying. I don't think people should have reacted as negatively to that, but
Well,
it just speaks to the sensitivity that exists today.
France has been saying that for decades, yeah. Way back to days of de Gaulle, yeah. So
Yeah.
Well,
So the sleeping dogs in this whole thing really is partly geopolitical and commercial real estate. That be fair to say?
Yeah, I think so. And then I think just the balance sheets of individual companies is going to be, I think it's going to matter more. And we haven't had to really worry about that because access to capital was so easy for so long.
Yeah.
And I think that shift is material.
Thank you,
Stephen,
Steve.
what about the debt ceiling?
I think we'll push it to the limit and then agree to something. But these guys, you can't tell if they want to go too far or not. But I suspect they'll just go to the end like they always do and make it more of a problem than it needs to be. I guess from your question, you think it's going to be worse, Duncan?
well, yeah, I was gonna say, Mark, what do you think, Duncan?
I think it could be worse.
Well, it could
I
be,
think
but
it could be worse.
what makes you think this will be the time where we cross the Rubicon?
I just think that there's the political, entrenched political ideologies are just, it's the only way you sort of play your hand. They've got to say that we want to, the country's money good. Everybody has to speak that speak. But when you get down to it, we've talked about it on this call. The spending in this country is just crazy. And this is the only tool to really control it. And I just feel like, we've come out of a period of time where it's been out of control. And so it just seems to me it's probably going to be an ugly one. And it's a little bit of another one of these things where, it hasn't happened for so long, that I think I've said this before, you've got people in, not to be disrespectful, but, there's people, 45-year-old person that's in a real position of managing money, decision-making. The last time this happened, they weren't in that position. And I don't know. I just feel like there's a chance it could be ugly.
It's interesting. One of the leading voices has been Joe Manchin about attacking this issue, which sets up for some interesting politics if he's going to push in that area.
What do you mean, Stephen?
That he's very focused on cutting the deficit and reining in the debt and supporting the spending commitments that we already have on Social Security and Medicare. So you have a Democrat who will probably not take the party line on just raise the ceiling. He's going to have a lot of the same views that, yes, some views that a real fiscal conservative would have in this area. And I think that sets up for some interesting politics to get this thing across the finish line, given how tight the voting is in both houses, in the House and Senate.
Fair enough. Michael, is that your hand back up?
Yes, it is. But for something different, the conversation between Duncan and Stephen, the debt ceiling, blocking raising it is a very blunt instrument for controlling debt. This is money that's already been allocated for spending. And both Republicans and Democrats have caused the increases in debt. They just want to spend on different things. So personally, and I'm pretty fiscally conservative, the way that you stop increasing spending is through the budget process, not through the debt ceiling.
No, they're incapable of doing it during the budget process, though, because you're right. They all have their things they want to spend on. So the debt ceiling is the only instrument they have where they can say it's somebody else's fault. It's actually the one time where you can blame it on somebody else.
Oh, great. So we take the china, smash it on the floor, and call it a win?
I'm not making a value judgment of it. I'm just commenting on the circumstance. So,
Yeah.
So Mark, you wanted a little controversy in the discussions? Here you go.
Yes.
On the controversy side,
Oh,
Stephen, I
here
agree with you.
we go. Now this is about to take off.
Here we go. No, I'll try and keep this measured, but on the controversy side, I very much agree with your view on the war that is unfolding in Europe and on the complacency surrounding it, because even here, there has been less focus given to it, more focus given to the cost of living crisis and to the coronation and other issues, even to the point where on an evening's basis on the national news at 10 o'clock, it is no longer sometimes mentioned. On some occasions, there is no reference to the war. And against that, what we see is an escalation of concern to the point where the government is now testing everyone's phones on the 23rd of April at 3:00 p.m. There's a nationwide test of an emergency alert on everyone's phones in this country so that they go off and they buzz so that we are notified this is a dry run for a future emergency. So there's clearly enough concern that the government is doing that, which I've never in my life seen, incidentally. And yet this war, which is certainly not going away, if not, it could be escalating. And there is much less voice given to it. And that is quite interesting to me, especially when I was in Poland 2 weeks ago, 700 kilometers from the border with Ukraine. It was interesting to see, or to hear actually, the artillery fire that one heard when one is running around town, so to speak. I mean, literally running around town. And you could hear artillery fire in the distance from training programs that were underway. And there was this sort of unusual sense of calm, but you knew that in the next country, there was utter turmoil. So this feels a lot closer here than the news is reflecting again. And I am quite surprised by this. I really genuinely hope that this does not, that American and certainly British support does not continue to wane.
Yeah, I think it's a European issue too. I think people are tired and worn from everything that's gone on the last couple of years. And it's at that time that bad things happen, when that level of complacency sets in.
Yep.
I'm surprised that the leaked classified documents haven't been mentioned.
Right. Right. I was going to mention that.
I'm surprised that people are surprised there's leaked documents when you could get documents by going to any politician's house and getting virtually any, confidential document we had, by going to their living room. So that there's stuff out there is not a surprise. So I don't know. Michael, are you surprised that there's stuff out there?
By the way, for what it's worth, I won't name the person, but he's very shrewd, both litigator and politician. Basically, he's called it for Biden. Trump gets the nomination despite all this, because this is, by the way, that issue is across the aisle. But nobody, he has the base enough to win. But nobody really wants Trump, and abortion is also going to be the issue that continues to carry it. So invest accordingly, he said.
I'll give you one other thing that isn't being talked about too much on Trump. While a lot of attention's been paid towards the Manhattan District Attorney Bregg's, case, he's got other issues, and it really is around Special Counsel Jack Smith, who is going to be coming likely with other charges against Trump. They're related to two different investigations. One is his treatment of classified documents, and the other is related to January 6th and whether there's a case for obstruction of justice. So it wouldn't be surprising if some other events hold Trump back from running. Let me just put it that way, Mark. And I would just say that whoever you think is going to get the nomination around this time usually doesn't get it at the end. So
just as sort of Duncan was making me rethink that we're always at least somewhat enlightened to avoid the calamity with the debt ceiling. This is a different era. This is not 2008 and other eras. I think he gets through. And despite you could have 5 cases against him. They're all basically going to be postponed. I'll see if I can get my friend to come on and shed light on all this. Remember back in the Kirkland Ellis Clinton case, he was involved and so he's never anyway. I say no politics, and I just waded back into those. Okay, what else? Just so we can't control that completely. I have on the screen what we're going to do on the West Coast, which and Safa. I've got you on. You're going to be with us even at the beginning. Let us skip through here. Whoops, I skipped too far. Let's see. The beginning is here, and even though. Some of the people here, like Cameron, Philip, are you able to maybe say a few words about?
Yeah, what would you like, just about what we're gonna talk about or?
Yeah.
Yeah,
just-
so I mean, I think that the general idea is just, to kind of start this whole thing off by just having a few people who are applying relatively different strategies at different stages of the VC space, just kind of talk about how do you invest in and play venture capital space when there's so much volatility and fear in the markets. I think personally that's the sign for me that makes me more bullish. I know that I think it was Stephen, it might have been you, but someone had all the keywords from the New York City event about what scares you the most, and VC was up there, and I go that makes me want to invest all the more. So it's going to be kind of the contrarian perspective on how do you invest in and take advantage of a bear market in the VC space. From Fuse, which is an early stage investment group, my family and our strategy is for late stage, and then Sean, I think maybe Mark, you can comment more on Sean's perspective. We have yet to connect directly, but I know that he's just a veteran in the space and a CIO for Meridian Capital, so he'll just have a lot of good perspectives on it as well.